Okay, so this is going to be something new, something different for this channel. It's going to be a 4-part series, and essentially we're going to look at over 20 companies, right, whose market cap is worth around about $10 billion or less. And these are companies voted for by over 200,000 investors that they believe the market cap of these companies will be worth at least $100 billion within the next 5 to 10 years. So essentially, we're trying to find the next 10 bagger. Now, I'm going to need your participation in this series as well. If there are any stocks that we go through who you also believe will be worth $100 billion within the next 5 to 10 years, comment in the section below, all right? It'll be really incredible if we can gather your thoughts. So I can't take any credit for any of the stocks listed today. It was Brian Ferrodi from Twitter and also on YouTube, who he asked his community, which spans over 200,000 investors, to essentially list these companies. And he filtered through all of their responses and then gathered a list of the top 20 most popularly mentioned, all right? So in this series, we're going to start from number 20 and work our way up to number 1. So the most popularly mentioned stock from all of these investors. And with that said, I'm just excited to get through this list. I mean, I don't own any of these companies, and I don't think I've spoken about any of them apart from one on this channel before. So hopefully this series gives you some brand new, fresh ideas. And yeah, if you gain any value, please make sure you smash the like button. If you're new to the channel, hit the subscribe button and let's get cracking. So first up, we have REDFIN. Ticker symbol is RDFN. And as you can see, REDFIN has a market cap of 4.991 billion. Okay, so the company is not yet profitable, so they don't have a PE ratio, which is going to be a very common theme amongst all of the stocks that we list in today's video. And the earnings per share is minus 0.22. Now, let's get a bit more information with regards to what REDFIN actually do. Okay, so we've got some key information here from Stock Card. So essentially, REDFIN is an internet-based real estate broker that notably pays its agents a salary as opposed to the traditional method of splitting a percentage of total commission. So it's a bit of a disruptive company because, of course, most real estate agents make their money on commissions. So with REDFIN, they're pretty much switching the script. They're an internet-based real estate broker. They essentially pay their agents a salary. I don't know how many agents will be happy with that because, I mean, some of these agents, they make bank from these commissions. So REDFIN are essentially taking that away and allowing it to charge home sellers a small fee to list. Okay, so I can see the attraction here for the home seller. Not really good for the agents, but good for the home seller. And the company has also recently expanded into iBuying through REDFIN now. Okay, so the company IPO'd July 2017, and their market cap is currently worth 4.9 billion. Now, I did take a look at their investor presentation, and there is demand. Look at their growing revenue. Their revenue is growing pretty significantly. As well as that, they are also beginning to take some market share in the US. So the US market share by value of homes sold back in 2015, they only had 0.44%. Now, fast forward 5 years later, they currently have 1% of the US market share. So that tells you there is quite significant demand. So they do have high growth potential. Real estate sector itself is expected to grow up by 2.8% per year between 2019 to 2026 globally. So again, that's globally. The real estate industry is expected to grow by 8% per year between 2021 to 2023 globally. So that's within the next 2 to 3 years. So that's decent, 8% per year. However, the core market, which is the real estate technology sector, that's expected to grow by 12% per year between 2020 and 2025 globally. So this is definitely a positive sign and definitely a positive start because it's a company who are growing their market share and they're also in an industry that has huge growth potential. Now let's take a quick look at REDFIN's sales growth. So over the last fiscal year, they're up 13.63%. The revenue from a quarterly year-over-year perspective is sitting at 120.59%. So I mean, these guys are killing it right now. They are crushing it. REDFIN are absolutely crushing it. The 3-year revenue compounded annual growth rate is sitting at 33.79%. The sales growth rate has trended downwards or has been decreasing by at least 10%. So that's not good. So that's a bit of a red flag. But their current fiscal year revenue growth is quite high at 102.44%. Now, like we've mentioned, the company is not yet profitable, so we will skip this. And let's take a look at their cash availability. So current ratio, very strong. Okay, their short-term assets are $6.68 2x the short-term liabilities, which is very good. So within the next 12 months, there's a low possibility of this company going bankrupt. The current ratio versus the benchmark is also very good because the company's current ratio is at least 10% higher than its industry benchmark, which is very good. Quick ratio again is 5.99, which is very good. The debt to equity ratio is neutral. Debt to equity ratio versus the benchmark is quite bad. Debt to affordability is also bad. And also over the last 12 months, free cash flow is negative. All right, let's take a look at management effectiveness. We're also getting some red flags here. Over the last 12 months, their return on invested capital is minus 1.33%. Not good. We don't have much information with regards to the benchmark. The last 12 months return on assets is also down at minus 1.16%. Return on assets, that's not very good. They don't have much information with regards to the ROA versus the benchmark, but the last 12 months return on equity is also negative 3.84%. All right, so let's take a look at analyst sentiment. I'm taking a look at the analyst consensus, and I mean, most analysts are calling this a hold. So at its current value right now, we've got 13 analysts calling this a hold, and with 3 analysts calling this a buy. So that's the analyst consensus. Let's take a quick look at some valuation metrics. Now, because the company is not yet profitable, a good metrics to look at is the PS ratio. So that's the price to sales ratio. And as you can see, back in February, it was quite high. It was at 10.30, and it's pretty much less than half of that right now. And the price to sales ratio is at 4. So if you are considering Redfin, I mean, right now it's pretty much halved its price to sales ratio value. So you are getting a bit of a discount from its all-time highs. Now, lastly on Redfin, let's take a look at the charts, and the price to sales ratio pretty much gave it away. I mean, this company was trading at nearly $100 back in February. So that's when the price to sales ratio was sitting at 10. But as you can see now, it's lost half its value and is currently trading at $47. And looking at the Fibonacci retracement, the company is trading below a key level of support. So right now, I mean, this company could continue falling lower, and the next support level is at $37. So yeah, let me know in the comment section below if you think Redfin has the potential to be worth $100 billion within the next 5 to 10 years. All right, so next up, we have YETI Holdings Inc. Okay, ticker symbol is YETI. And this company is profitable. I mean, they've got a market cap of $8.62 billion with a PE ratio of 43.53, and the trailing 12-month EPS is sitting at 2.27. Now, let's get a bit more information with regards to YETI Holdings. So, YETI Holdings is a designer, marketer, and distributor of premium products for the outdoor and recreation market sold under the YETI brand. Okay, so the company offers products including coolers and equipment, drinkware, and other accessories. Its trademark products include YETI, Tundra, Hopper, YETI Tank, Rambler, and all of these other trademarks. So to provide you guys with a better visualization of what these guys do, we got their investor presentation, and here you can see how their coolers and their equipment looks like. They've also got drinkware, and yeah, as you can see, they're pretty much large, durable containers. This is a good representation here. You can store your drinks, keep them cool, keep them chilled for barbecues, and they've got the YETI brand there. All right, so very simple, easy business to understand. Let's take a look at their growth potential, and they're rated as a high growth. The consumer cyclicals is expected to grow at 3.9% per year between 2000 to 2003 globally. I wouldn't say that was massive growth. I mean, 3.9%. Redfin definitely had a lot more growth potential. The leisure industry is a bit more interesting. That's expected to grow at 5.6% per year between 2020 to 2026 globally. Decent growth. It's definitely not on par with Redfin, but they've got very strong operations. Okay, so if you look at their last fiscal revenue year growth, that was sitting at 19.48%. So that's very good. From a quarterly year-over-year growth, sitting at 44.84%. You can imagine these current conditions with the C Roni and the D variant, going crazy. A lot more people are choosing to camp. And alongside that, we have the rise of staycations. You can understand why their products and services are doing very well. That's fantastic quarterly growth from a year-over-year perspective. Their 3-year compounded annual growth rate is very good, 19.53%. So, I mean, this company, there's a lot of demand for this company. Very, very good. The revenue growth trend is currently rated as neutral, but the current fiscal year revenue growth estimates is sitting at 28.12%. This company is ticking a lot of boxes. As you can see, it's ticking a lot of boxes. They are profitable. You know, their last fiscal year earnings per share was $1.79, which is positive. That's good. The last 12 months APS is sitting at $2.30. Again, positive. The earnings per share growth is increased by over 10%. Again, it's ticking all the right boxes. Their gross margins are also extremely healthy from a quarterly perspective, and that's 58.47%. So YETI, I really like YETI. I can't lie. I do like the fact that YETI are ticking a lot of boxes. If you look at their cash availability as well, looks like they have a very strong balance sheet. Within the next 12 months, they've got a great current ratio at 1.6x the short-term liabilities. So that's their short-term assets. Current ratio versus benchmark is rated as neutral. Quick ratio is good at 1.11. Debt to equity ratio is also very good. So they have no long-term debt, or debt is manageable when compared with the company's equity. So very, very good sign. And as you can see, I mean, YETI is ticking a lot of boxes. And to be honest, I had never heard of YETI before. It's not a popular brand within the UK, at least that I'm aware of. But I mean, this company looks very solid. Okay, so let's take a look at management effectiveness. Again, ticking all the right boxes. The last 12 months return on capital invested is 43.52%. That is crazy high. That is very, very good from management. Versus a benchmark is also rated good. The last 12 months return on assets is 27.30%. And that versus the benchmark is at least 10% higher than its sector's benchmark. I mean, I have nothing negative to say about YETI right now. They are looking absolutely solid. Let's look at the analyst consensus. So 8 analysts recommends YETI as a buy, and you have 5 analysts rating YETI as a hold, with 0 analysts covering the stock at a sell. Let's take a quick look at their valuation metrics. Okay, so YETI holdings are not really looking like they're at a discount right now. Their price to sales ratio is at their all-time highs, which I wouldn't say is surprising because they are profitable and they are growing at double-digit rates. So this company is a solid growth stock right now, but the price to sales ratio is quite high. So I don't think you are getting a discount. And their PE ratio, though, is down. Their PE ratio is down at 40. So I guess if you're using the PE ratio as your valuation metrics, the price to earnings ratio has considerably calmed from its highs back in January, where it was over 60. So it's currently at 40. Now let's take a quick look at the stock chart with regards to the Fibonacci. And yeah, as you can see, it's currently trading at near its all-time highs at $98, with the next support level sitting at $84.18. So yeah, it's quite expensive. I mean, you're buying it at its highest valuation. I mean, the company are performing, but if you are considering a discount, you know, I would like to see it test $84. This support level here, that would be very good to see. So that is YETI Holdings, ticker symbol YETI. Next up, we have TWST Bioscience Corporations. Ticker symbol is TWST. Currently with a market cap of 4.9 billion. Company is not profitable, and the earnings per share is minus 2.88. So let's get a bit more information with regards to what TWST actually do. So TWST Bioscience Corp is a synthetic biological company. It develops a disruptive DNA synthesis platform to industrialize the engineering of biology. Okay, so they're using buzzwords here: disruptive DNA synthesis platform, you know, to engineering of biology. So these are, I mean, beautiful buzzwords, but what does it all mean? So the company's DNA synthesis platform utilizes a proprietary semiconductor-based synthetic DNA manufacturing process that synthesizes DNA on silicon instead of on traditional plastic plates to enable the production of high quality synthetic DNA faster and affordable, as well as overcomes inefficiencies and power cost effective rapid high throughput synthesis, enabling researchers to rapidly realize opportunities ahead. Okay, so mad. That's that's not an easy business to understand. So I went on their investor presentation, and these are the solutions that they offer. So there's genes, oligopools, variant libraries, and also pharma biotech solutions. All right. So I will say off the bat, it's not an easy business to understand, but they do have high growth potential. Okay, so obviously the healthcare sector itself is a rapidly growing sector, 8.9% globally. And also the industry, which is diagnostics and research, is also expected to grow at 5.2% per year between 2020 to 2025 globally. I'm taking a look at their operations, and I mean, they do have some greens. There are some boxes that are ticks, which is very good. Their last fiscal year revenue growth grew at 65.67%. Very good. Their revenue from a quarterly year-over-year growth is also 65%. So, I mean, the company are growing their top line, which is very good. Their 3-year compounded annual growth rate is 103%. That's fantastic. That is fantastic, okay? Their revenue growth trend, though, has slowed. It's trended downward or has been decreasing by at least 10%. But their current fiscal year revenue growth estimates is at 44.93%. So they are ticking a lot of boxes. I do love the way their top line is growing. Profitability, we know the company is not yet profitable. Let's take a look at their balance sheet, and their current ratio is also very good at 9.29x. The short-term liabilities, that's the short-term assets. The company's quick ratio is 8.78, which is very good. Debt to equity ratio is also good. Debt to equity ratio versus the benchmark is very good. Debt to affordability isn't good. It's been rated bad. Also, their last 12 months free cash flow, which is also negative. So that's negative 123.84 million. Okay, so that's a bit of a ding. Let's take a look at management effectiveness. Not very good. So their last 12 months return on invested capital has been rated bad. It's been rated bad for their return on assets, and also over the last 12 months return on equity has also been rated bad. All right, so management are not showing great effectiveness. 3 analysts calling this a buy, and 3 analysts are calling this a hold. Now moving on to their valuation metrics, and it is trading at a considerable discount to its highs back in February. I mean, a lot of these stocks are. The price to sales ratio was pretty much nearing 90. Mad. But right now it's at 37. So it's pretty much lost more than half of its value. So let's take a quick look at where they are sat on the charts. And again, very similar story. It was trading quite rich. I mean, it was worth $213 back in early January, and it's now trading around $100 right now. So it has come down quite significantly, and it's also at a decent support level if you are looking at the Fibonacci retracement tool. So if you are interested in this company, and if you do think this company will be worth $100 billion within the next 5 to 10 years, you are getting it at a discount from its all-time highs. Okay, so next up we have Virgin Galactic. Ticker symbol is SPCE. And this is the only stock in the list that I have mentioned on my channel before. I'm sure most of you guys are pretty familiar with Virgin Galactic, so that's owned by Richard Branson. Current market cap of the company is 6.31 billion, and as you guys already know, the company are not profitable yet, but they do have a negative earnings per share, trailing 12 months of 1.79. However, in case you're not familiar with Virgin Galactic, they are a US-based vertically integrated aerospace company pioneering human spaceflight for private individuals and researchers, and it also manufactures advanced air and space vehicles. So if you have been in the investing scene for the past 2 to 3 months, Richard Branson recently went into space. He was testing out the customer experience, and he also had some other researchers and members of the Virgin Galactic team with him, and there you can see them all floating around in space, and he gave a very awe-inspiring speech. So massive respect for Richard Branson. But a key point from this presentation is that the company have reopened the sales effective from essentially when Richard Branson went to space. Sales are opening back up, and the prices are up. Okay, so I believe the prices used to be about $250,000, but prices now begin at $450,000. And again, they've got multi-seat packages, they've got full flight buyouts, and also single seats. Okay, and I can see Virgin Galactic, if they do get this right, it could easily be worth $100 billion because they are the trailblazers right now. I know Blue Origin are pretty much also in level with Virgin Galactic, but in terms of competition, there's not many. You've got Blue Origin, you've got obviously SpaceX. I don't think they're into space tourism for private individuals just yet. So I mean, the main two front runners are Jeff Bezos with Blue Origin and Richard Branson with Virgin Galactic. So there is a significant wide moat just from that point of view. Now, the growth potential, of course, in my opinion, is huge. Okay, so the core market is space launch services, and that's expected to grow at 15.20% per year between 2020 to 2025 globally. Aerospace and defense, I wouldn't say is really their main sector. It's more tourism, all right, for private individuals, and also the sector as well is in industrials. But again, you can say Virgin Galactic have carved out their own niche, so I wouldn't say this is applicable. I'm not going to waste any time on sales growth or revenues because essentially the company are not profitable. It is reassuring to see that they have opened up their sales again, and they've also increased the prices of their tickets. So we'll take a look at analyst consensus. You've got 4 analysts calling this a buy. You've got 4 analysts calling this a hold. And lastly, you have 2 analysts calling this a sell. So mixed, very, very mixed reviews right now. Again, there'll be no data with regards to the price to sales ratio or the PE ratio. But if you take a look at their share price, and I mean, this has been a yo-yo of a stock. This stock is as volatile as it gets. I mean, at one point it was trading at $60 a share. So this was back in January, February. And then again, the stock tanked to lows of $16. Then it soared once again when Richard Branson was going to space to highs of about $57. And now it's back down to $24, which is just crazy. It's as volatile as it gets. So if you are interested in getting involved with Virgin Galactic, I mean, you're buying it at a considerable discount from its highs. And it is a stock that I am confident if they do play their cards right, they could be worth $100 billion. Yeah, Virgin Galactic is the next. Okay, so the last stock in this first series is OZON Holdings PLC. Okay, ticker symbol is OZON. And these guys are just slightly above their threshold. Their market cap is still 10 billion, so we'll give it that. So it's about 10 billion, all right? It's another one that isn't profitable just yet, and the earnings per share is minus 2.31. Now, what do OZON do? And OZON are essentially a multi-category e-commerce platform. All right, okay. I've never heard of them. It provides customers with the widest selection of goods and door delivery across Russia. Okay, so across Russia's 11 time zones. So are they essentially the Amazon of Russia? Maybe, or maybe the Alibaba of China. Who knows? The firm operates in 2 segments. The OZON.RU segment engages in sales in multi-category consumer products through the OZON mobile app and OZON website. Okay, and they also have the OZON travel segment, okay, which comprises sales of airline and train tickets through OZON travel mobile app and the OZON travel website. So they did IPO quite recently, last year to be exact. So moving on to their growth potential, and they've been rated to have high growth potential. They're in the consumer cyclical sector, which is growing at 3.9% per year between 2020 to 2023 globally. But the internet retail sector is a beast. It's a beast. All you have to do is look at Amazon. That sector, the e-commerce is an absolute beast, okay? But it is slowing. It is a beast that is slowing. The growth is expected to be only 9.4% per year between 2020 to 2027 globally. And if you look at their operations, I mean, they've got some green. We love to see green. Their last fiscal year revenue growth was at 56.34%, which is very good. Their revenue quarterly year-over-year growth is very high at 48.87%. So again, they're doing very well, considering that you would expect their revenue to probably slow in comparison to last year, where there was lockdowns in Russia also, but they're still growing their top line regardless, which is very good to see. So we don't have much data with regards to the 3-year compounded annual growth rates or the revenue growth trend just yet, but their current fiscal year revenue estimate is at 61.47%. So the company isn't profitable just yet. The cash availability is very good. Current ratio is quite strong, 2.07x. Current ratio versus the benchmark has also been rated very good. Quick ratios at 1.79. Debt to equity ratio is also good, but versus the benchmark has been rated as a bad. And debt to affordability and also the last 12 months cash flow is negative. All right, so that's bad. Let's take a look at management effectiveness, and they've been marked down on that. So the last 12 months, looking at negative 42.89% for the return on invested capital. That's quite bad. That's quite bad. And also the same thing with the return on assets at minus 23% and the return on equity minus 84%. Management are not showing that much effectiveness, at least over the last 12 months. And let's take a look at analyst consensus, and they're pretty much split. You've got 5 analysts calling this a buy, and you've got 5 analysts calling this a hold. So they're split, but no analysts are calling this a sell, which is very, very good. Of course, with the growth of the e-commerce side, you can say this company does have potential. Taking a look at Ozone Holdings price to sales ratio, and it's absolutely pretty much almost slashed in half, right? It's trading at 4.9, but it was at 7.6, okay, back in February. And that, of course, will be reflected in the stock price, because as you can see right here, I mean, it was trading at near $70 at its highs back in February, and it's now trading at $49, and it's at a key level of support right now. So it could potentially bounce off the support and go higher, or it could continue lower and test $44.55. So Ozone Holdings PLC, ticker symbol is OZON. Let me know your thoughts in the comment section below. Okay, so that wraps up number 20 to number 16. I hope you found this video very valuable, and I hope it's given you some fresh ideas for you to then build your research on in any of the stocks that you like. Make sure you comment below which one of these 5 stocks you think has 10 bagger potential. I would love to hear your thoughts. I think for me, out of the companies that we've mentioned, I would probably say Space takes it for me, Virgin Galactic. But I do also really like REDFIN. I do see a lot of potential with REDFIN. I also do think YETI has potential, but I'm not sure whether it has 10 bagger potential. I mean, the company is already profitable. I think eventually a company like YETI, you can see it becoming a dividend stock eventually. So I don't really see it as a high growth stock, but I do like the business model. They are profitable. Management have proved themselves to be very effective. But yeah, let me know in the comment section below what you guys think. So thanks so much for watching, and I'll catch you in the next one. Peace.